Welcome back now. Market news now as Asian markets fell this morning, putting their region on course to end a probably positive week on what was a sour note, with China showing more signs of weakness while traders took their profits off the table. There was also some unease after the head of the European Central Bank raised concerns about the growth outlook for the Eurozone, a lot of that owing to issues within and also outside the bloc. The Santa Claus rally looks to have lost steam, with the Nikkei slipping 2% at close. In Hong Kong, the Hang Seng was down 1.6% to 26,094 points, while the Shanghai Composite ended the day 1.5% cheaper. That's by close. The S&P 500 ended little changed after a volatile session on Thursday. This came as investors decided to favor defensive sectors, while the biggest drag came from financials and consumer discretionary stocks. The Dow Jones picked up almost 0.33% to close at 24,597 points. The S&P 500, as I said, almost unchanged at 2,651 points, while the Nasdaq Composite lost 0.4% to close the day's trading at 7,070 points. Well, it has been an interesting week, hasn't it, across the board? Markets going up one day, down the next, but certainly an interesting picture for the last 3 days. We saw positive trading, particularly out of Europe and even locally. But as you can tell this morning, China in negative territory, and obviously that will probably filter through into today's market trade, having seen sort of a mixed picture out of the United States yesterday. Let's check in on how those markets are faring, and we'll take a look at the week on point. Distinct weakness there in South Africa's currency as well, and the oil price just getting better above $61 a barrel. Let's get into your week on point now. The latest week has been one that has certainly brought a whole host of news coming through. So let's unpack all of it. A slew of economic data came out this week, including this morning with the quarterly bulletin, but we'll chat about that in just a bit. But the most important data I certainly felt was that inflation number, perhaps justifying the reason why the South African Reserve Bank decided to hike interest rates by 25 basis points last month. That's November, of course. It was what some may deem a surprise decision, even though it did hinge on a 50-50 split between the South African Reserve Bank's Monetary Policy Committee, but perhaps rising now to 5.2% there for inflation. And as you can tell then, it certainly set the mark of how things are faring when it comes across for South Africa. The general outlay, as you can tell, for this year has been within the Reserve Bank's 3 to 6% target band, which has been quite significant for some time, but it seems at this point that 4.5%, the middle point between this 3 to 6% target range, has been quite key for the South African Reserve Bank. They've looked at that to determine what actually happens for interest rates across the board for South Africa. But as you can see, things going a little bit higher, and with that they decided to increase interest rates. They did say they see the prospect of how things fare in future as a key risk. Another key risk will be electricity prices. How that does in future will certainly impact that inflation number. It may even impact South Africa's growth numbers, because manufacturing may suffer due to a fall in electricity being produced and given out to consumers due to load shedding. So this inflation number is one to certainly look out for, and we'll unpack it as it comes on board, of course, right here on point with Market Sense. Let's continue now to some other news. Internationally as well, it's been quite a critical era. The trade truce between China and the United States has been a focal point for quite some time. So Donald Trump himself literally speaking out and saying that he has established a fantastic relationship with President Xi Jinping of China, who is the head of China, the absolute head. And of course, Donald Trump loving the fact that he indeed rules China as he does. And I think we are going to work a fantastic deal for both countries, but a fantastic deal for us. That's the United States. We are going to get China to open up. Certainly a move there by Donald Trump, saying that he's going to make sure that it is America first. He's maintained that sort of thought for quite some time, and it is clear right now as well that he will continue to think like that and try to find a deal that will sort itself out for the United States. March is not very far. Remember now, 2 deadlines. We've got that, the trade truce between the United States and China as well. But here's the most significant one. March 29th is Brexit Day. Following this ballot, we now need to get on with the job of delivering Brexit for the British people and building a better future for this country. Theresa May, the United Kingdom's Prime Minister there, saying indeed it is time to get on with the job. This came right after she had survived a call of no confidence against her. She led that 200 votes to 117. It certainly does, however, form an interesting analysis to note that 117 members of her own party indeed saying that they don't think she should lead the party as Brexit forms and as they try to clear the mire. So indeed, she then said she will not lead the party headed into the next election, and she will then resign before 2022. How that comes to the fore will be quite interesting. That Brexit deal, however, does need to be sorted out in order to sort and get some clarity throughout that European segment. Those 27 countries remaining in the EU saying that they're not willing to renegotiate the deal, so it will be quite interesting if indeed the UK accepts the deal as it currently stands or if they wish to change things. Let's get into the number of the week. Now, this number coming out not so long ago, this morning, in fact, 3 billion rand. Why? Because this has been the year where President Cyril Ramaphosa has asked that we try and get as much investment into South Africa as possible, of course. A lot of that coming in the form of foreign flows, right? So the likes of China, having come through before the BRICS meeting, certainly pointed out that they would like to invest in South Africa. We had the investment conference as well, which showed a great amount being brought into South Africa, around 300 billion rand on that front there too. And then we get to see things, of course, then like the Africa Investment Forum, which took place as well late on in the year. Again, more investment into South Africa. But unfortunately, the South African Reserve Bank saying that foreign direct investment inflows fell by nearly 3 billion rand in the third quarter. That came as foreign firms sent less money to local subsidiaries. A difficult factor to face there, President Cyril Ramaphosa. Still, it's not the environment he would certainly want, and hopefully he can get that figure to go a little bit higher with an enabling environment. That is your week on point. Let's continue to unpack the market, however. As I said, it was a topsy-turvy one across the week. It has been one where we saw markets go up, go down. We expected a Santa Claus rally and markets perhaps getting a little bit better as we close out the year. It isn't to be just yet. Warwick Lucas from Galileo Capital joining us now as we unpack this market picture a whole lot more. Thank you so much for your time, Warwick. It hasn't been easy. We thought for 3 days that we've perhaps started it and perhaps we preempted it a little bit more, but today, not so much so. As you can tell, from China right through to the local market, things aren't looking too good.
Yeah, very pesky, those short-term bull markets, aren't they? Yeah, I mean, it's certainly a bigger buffet of uncertainty than I think we were looking for initially. Clearly, Brexit attracting a lot more attention and focus than it probably deserves. And I think some of the market excitement is frankly over-excitement.
Yeah, and that indeed is the way the markets have pushed along, right? We expect one thing to happen, but a totally different thing sort of happens. The market is probably primed for an uptick, though, right? Surely any piece of good news will do at this point in time, but it just doesn't seem to be coming.
Yeah, it certainly would be helpful. I mean, we're still looking to see something positive out of US-China. I think given the time of year, we're probably not going to see an awful lot more there, and some relatively muted economic data out of China, well, that tended to put a bit of a dampener on it. As far as Brexit goes, I think far too much of a meal being made about it in all quarters. I think the reality is that a country that survived the Blitz and the Spanish Armada is hardly going to get blown up by leaving a treaty. So I think completely overstated there.
It's just about sureties, though, right? It's about making sure that the market doesn't perhaps have a huge blip as it gets out of this, out of the block.
I think part of the problem is that there is so much contention that instead of genuine debate happening, real debating points are just being chucked around as hand grenades. I think the deeper reality that is getting missed here is that the EU is in danger of doing itself damage. I mean, certainly in pure trade terms, the EU is losing a partner to whom it has a trade surplus of about £70 billion a year. And at the same time, the EU is picking assorted fights with Italy, Poland, Romania and Hungary. And this isn't the kind of thing that healthy unions are made of. So whereas the UK can protect itself by having the sterling exchange rate act as a shock absorber, the EU actually does not have so many places to hide.
And that's the scary part, right? That the 27 nations then saying as well that they're not going to renegotiate this, maybe change a few words, but the deal in itself stands. So it's now about making sure that it runs through the parliament in the United Kingdom and hopefully it gets approved. If not, we're going to a no-deal Brexit by January 21. That means March 29th, as they're expected to leave. We may indeed have the worst case scenario there for the United Kingdom. But let's bring things home just a little bit as well then. We saw the likes of Aspen suffer a little bit yesterday, coming out with a statement saying they may sell one of their biggest one portfolio of theirs worth around 1.9 billion or so, nearly 2 billion rand. That's certainly bound to hurt the company. They then tried to offer out clarification today, but that stock down nearly 9% as well. The business itself has come under a whole lot of scrutiny.
Absolutely. I mean, they're talking about adjustment and debt covenants, and I think it then goes back to the point that I've raised from time to time here in the past, and that was the whole issue that debt in this group was understated, and it remains an important issue. Now, management are finally making the right moves and attempting to de-gear their portfolio, but frankly, they are now behind the curve, and getting in front of the curve is what is necessary to restore confidence there.
They're down right now 8 1/3% there. That's 11 points there, 11.2. They're currently sitting at 129 rand and 82 cents. I wish I could show you this graph. I mean, falling from the highs of close to 300 rand a share, now sitting at 129, more than half of that valuation lost. And that's only since September or so. So things are really not good in that front.
It's a miserable picture, and it's common to any company that goes into the near future in a heavily geared situation. I mean, we're looking at a situation where the US might say that it's interest rate neutral, but it's effectively in a debt deflation situation. So that means that debt in real terms is still very expensive and can put real pressure, particularly on emerging market companies. And companies need to make sure that their balance sheets are now in good order, because it is a trickier interest rate environment going forward.
What are you looking at for the next sort of week and a half so as we close off the year that is going to be of keen interest to the markets? Of course, we saw Mario Draghi speaking yesterday. Things aren't looking too great on that front. What else is set to be an eye-opener, I suppose, for the remainder of this year that we can perhaps look at to jolt markets a bit?
I think I'm looking more locally. I'm looking for SA Inc. to quietly just keep pulling its feet back under itself and pull things together. And I think we are seeing the makings of that, but it is slow and difficult. Quite a lot of recovery that's got to come through. This economy has clearly been under severe stress, and we can see it, for example, let's look at our PPI and inflation data there. I mean, we're still recovering. When you look at the common threads all through there, was the impact of a weak currency combined with high oil price, and that data should actually start improving come December when the weaker oil price actually starts coming through.
One can only hope. Thank you so much for your time. Warwick Lucas from Galileo Capital there, having joined us, of course, and enjoy your festive season if we don't see you again. Indeed, that's going to be an interesting time, of course.